Hi, everyone. Welcome to Tech Uncensored. Today, for startup founders, investment is often the key to actually accelerating the growth of your organization. But the decision to actually seek outside investment requires some careful consideration and preparation. So once a founder decides that they want to pursue external funding, they have to prepare for the demands of the process and knowing that external funding requires some kind of significant time as well as resources outside of what they do on a day-to-day basis. My name's Hetty Jones, and there are many things to think about once a founder decides that they want to raise capital. And today we're going to be talking about some of the building blocks of fundraising and structuring your organization. Is the founder personally ready for the increased pressure and expectations that actually comes with raising capital? Are they prepared to relinquish some of the control and autonomy that they already have? Being business ready is paramount, and founders have to have a clear vision, not only for their organization, but be able to really articulate how funding is going to accelerate some of these market opportunities. The other thing that's important is understanding the investor perspective, and they need to realize that investors evaluate opportunities through a different lens, and they start to think about what are the criteria that an investor cares about. When you are going to be investor ready, it means that you're going to be prepared to answer some questions from investors about your team, about your operations, your business model, your traction, the risks to your organization, and questions about the vision and whether or not it's really market viable. And most importantly, you have to have the documents and the materials for investors to actually thoroughly do due diligence on your organization. So ensuring that the company structure is suitable for investment is a critical preparatory step. And today, I'm pleased to welcome Mujir Munirudin from Pallet Vallo. And he is a partner with this organization, and he's a corporate and securities lawyer with a background in C-suite technology. He is also a real estate entrepreneur, and he has a track record of building, aiding, and advising transformative companies. And today, I'm so happy that Mujir is with me to help guide startup founders when it comes to fundraising strategies. We're going to help. He's going to help us differentiate the difference between debt as well as equity financing. We'll discuss investor expectations. What are the founder preparations that also need to be done, and to really ensure that founders have a structure for their business that's effective so that they can make informed strategies and decisions as they grow. So welcome, Mujir.
Thanks so much, Hessie. Thanks for having me.
So just so everybody knows, Pallet Vallo is an important partner for Altitude Accelerator, and they continuously provide great guidance for many of our clients in helping them grow their businesses. And structuring your company is one of the major things that they provide. So I'm going to ask questions from a founder's perspective, but it'll be also good to understand this from the investor side. So let's start with the question of timing. When's the right time for a company to consider raising capital?
That's a great question, Hessie. And I think you made a really important distinction earlier when you said that it's very important to look at investment before you even jump into it from the investor's perspective, because they're looking at success. They're looking at an end result that in some ways is different than yours. As a founder, you've got a passion. In many cases, it might represent the culmination of your life's work and your education and your training to get to that point. An investor is just looking to jump on the train and get to a destination. And sometimes it can seem a bit tawdry to a founder, and they start getting offended, like, all you care about is money. But that's what they signed on for. They signed on for that last leg of the journey, right? So it's important to conceptualize that before you start shaking hands with those types of people. And there's nothing, and understanding there's nothing wrong with that. That actually is the mechanism by which businesses get funded and how your bread gets buttered at the end of the day, right? Is by investors looking to make money and being opportunistic. You can align both of your destinations and your interests in a way that is good for everybody. And so I think that's the first thing to really understand before you decide to make that plunge, if you will, into taking outside investment. So to get to your question, Hesse, I think the most important thing to consider, or the gospel, as I'll say, when it comes to deciding when to take an outside investment, is always later. You always want to push that moment down the road, because no matter what, the moment you bring in an outside investor, you've got somebody from the outside looking in, asking you questions, and it's only natural for those questions and that oversight to start shaping your decisions and making you less creative, making you less, in some ways, true to your vision, right? And you'll see it all the time where the OSC and regulators in Canada have done a great job of providing early stage mechanisms for companies to go public or raise outside investors. But you've seen so many horror stories in the market of companies that just went to the market too soon. And not only does it dilute the founders, but it actually takes you away from your vision at such an early stage. Because, and I remember Jeff Bezos had a great quote, and I'm going to really butcher the quote here, but he said something to the effect of, "I'm in the business of being comfortable with being misunderstood for long periods of time." In other words, I'm okay with people thinking I'm a moron because I'm going into a deep dive and I'm coming out on the other end with a stronger business in ways that throughout that entire cycle didn't necessarily make sense, right? And when you go public or you raise outside investors, but public being the most extreme example, right off the bat, your idea of long-term growth is defined in terms of quarters now. Okay, so does that mean you're going to hit profit in quarter 2, quarter 3? What does that mean? So it changes your entire mindset. Now you're answering to a whole different legion of questioners and answering a different array of questions that are going to take you away from the business, because the fundamental reality for companies is there's the business and the operational side, and then there's the capital market side. And if you engage with that side of the realm too soon, right off the bat, you're dividing yourself. So you've got to be ready to take that plunge, right? And another important factor in what I call the valuation principle, as we've discussed in the past, is the further along you can get your company, the more de-risked it is for the investor, the more, for example, revenue or other milestones you're going to have, such that your company is more valuable, right? And the more valuable your company is, the less of it you can sell for more, right? That's really the best way of simplifying it, to really have the audience understand what the valuation principle is all about. So you really want to kick that down the road as much as you can to maximize your valuation, which minimize your dilution.
And the one thing that's, I think it's important from this perspective, because a lot of founders, when they need to raise, sometimes it's a cash flow crunch. Yeah. They need money to be able to finish development of this, or need to do this. And I keep saying, don't use that as your motivation to raise money. It's because if you need $18,000 only to do this one thing, I said, be careful about what that will cost you from an equity perspective. What do you say to companies who try to get an influx of cash because they need it, as opposed to, for a small short-term raise?
Yeah, well, Hesse, they say in vernacular, the worst time to buy a car is when you need to buy a car, right? Mm. And it's kind of like that when it comes to financing. Is the worst time to go to the market to raise money is when you need it. If it's not in an orderly way, the investors, especially the more sophisticated among them, are going to be able to sniff out your desperation right off the bat. And everything I just said about the valuation principle gets discounted down, because even if you're further along, but you're cash crunched, that just makes your investors salivate even more. So you've got to be really careful that you've got your 18 to 24 month runway planned out, and maybe you're raising money at the 6 or 12 month marker, because what you're showing people is, yeah, I will need the money. You can't shirk me around here because I can go find somebody else in the next 6 to 12 months. So you really got to time it perfectly. And the other aspect of that timing that we've spoke about in the past, and we'll say it here for the audience's benefit, is being deal ready. The last thing you want when you're going to the market and doing so in an orderly fashion is doing all that at the last second and then having to come up with some spectacular effort just to be deal ready. You're better off just making sure things are done right as and when they happen. You issue, to use very basic terms, you issue shares and you document it when it happens, instead of waiting for an audit where you hire lawyers and pay tens of thousands of dollars to catch up on what you could have done for hundreds of dollars at the right time. Deal ready, and the state of being deal ready doesn't need to be a spectacular thing if you do the right things on a first principles basis, unspectacularly throughout the process.
Okay. So when you say deal ready, it's going to be different for an early stage founder pre-revenue versus one that's ready for growth. Because obviously there are going to be records that are available for that when you're in the growth stage versus pre-revenue, where a lot of it is still very much speculative and modeling, financial modeling, I would assume.
Yeah. And Hesse, I think it's important to have those conversations in the industry, right? I just had a conversation with actually an Altitude alum, incidentally, a few days ago, whose business has done spectacularly well. And, you know, this founder and his team have done a great job actually keeping things up in earnest, such that when they came to me, it was totally surprising to them that we had a conversation on, say, Monday about, hey, Mujir, how do I have a good conversation with the guy who might be interested? And actually taking it a step back, he wasn't even necessarily having a conversation. He was just saying, how do I be deal ready? Should I look at doing a term sheet? And should I look at certain strategies? And I kind of walked him through the process. And amazingly, one of the first meetings that he had actually got him a term sheet. So the best thing for him was he was actually deal ready when he had that conversation, right? And a lot of that deal, not necessarily that deal, but a lot of deals are very timely, right? Because so many things are coming together. It's the market, it's interest rates, it's opportunities, it's things that are subjective to the buyer, where he or she needs a particular opportunity to synergize with the rest of their portfolio. There's so many factors that come together to create that unique time that you don't want to miss that bus of opportunity, because you've got to get your minute books and get an audit done, and that's going to take you 6 to 9 months, right?
Exactly.
Because then you're going to be like, oh man, I just wish I did at the time I could have, as opposed to waiting for the right moment, which is, it's too late already, right? Okay. And so this particular alum was deal ready without even necessarily knowing. And, you know, I don't know if they're going to do that deal, but it's great that they're ready to do it if they want to.
So some of the things that you talked about are probably some things that founders haven't even done yet, or they haven't even thought about, like when you talk about minute books, etc. So let's get into some of that. Let's start with the industry that a startup operates in, and how does that influence the type of financing that they should pursue?
Yeah, no, that's a great question, Hesse, and it has a very big impact on the type of investments that are attracted to your business, and vice versa, the ones that you realistically should pursue. So for example, if you're in real estate, excuse me, the primary method of financing would be typically loans or lending, financing where you're taking on a debt instrument. There might be, usually with loans, there's some sort of debt servicing component. So you're going to have to pay some periodical interest payment every quarter, every month, or every year. In some rare cases, you can get a bullet financing on the back end where you say, look, it's a 2-year term and I'll pay everything back on on maturity. And it can be alluring for a lot of startup founders to go the debt financing route because you think, oh, there's no dilution, right? But then it creates this maximal impact of stress and risk on the back end if you can't actually come up with that money on the redemption. And typically lenders at earlier stages in Canada for sure are taking a personal guarantee. So now your personal assets, maybe your house, are at risk, right? So you really want to balance the allure of this big upside with the risk. And it's important that you understand what you're getting into. And so that's on the real estate side. On the tech side, because you don't really have typically real estate or hard assets with which to secure a loan, typically it comes down to your projections, the value proposition of your business, the strength of your founders, the projections that an investor is going to make a very big bet on. And the typical profile of an investor in this venture capital, in the VC, private equity, high growth space, emerging corporation space, is that they're going to take 10 or 20 positions and expect 18 or 19 of them to fail to get that one home run, right? So it's a different mindset of an investor that you're looking at. But by that token, from their psyche's perspective, if they're going to take a risk and take a chance on your business, they're going to go for a massive home run, right? Because they have to in order for their portfolio to make sense. So they're going to take an equity position that gives them a huge part of the upside, because to them, they're taking on an inordinate amount of risk by coming on to your business at an early stage when most others would not. So it's really a catch-22, and you've got to balance those two things. But those are two examples of where industries will largely dictate the type of financing that you can get and that you should realistically look for. Not to say there aren't exceptions, but generally, if you want to veer outside those boxes, you've got to be very careful, because there's a reason why the market tends to go in a certain way versus the other. And anytime you want to be outside the box, you've got to really understand the implications of being outside the box and why most people don't do things the way you are, if that makes sense.
Yeah, I think we also have to call out the fact that there are certain sectors of the industry, whether or not it be not for profit, as well as the services industry, that don't really apply when it comes to equity, because in many cases, let's say within the services industry, there is no, I guess, unless you're willing to sell the company, unless there's something that's tech enabled that allows it to scale and allows an investor to make a whole lot of money in a short amount of time, typically that this doesn't happen.
Right? Exactly. And you hit it on the head, Hesse. That's really the point that I was making earlier. Most service businesses, unless they're SaaS or something that can scale exponentially, are very dissuasive to an investor who is now taking on a lot of risk with a linear return on their investment. So it's not really attractive to them, right? Because they're saying, look, you're running a consulting business, or you're running a let's say a cleaning business, which is great, good, robust cash flow, but I'm going to come in and put money in. Well, let's assume that there's no cash flow, because cash flow kind of changes things, and you can probably get a debt type of investor in that situation. But if it's a service industry, say, for example, somebody starting up a law firm or an accounting firm, and other people are investing, assuming you can do that legally within the professional rules of conduct, it's still very risky for the investor, because a law business or an accounting business is not that different than most businesses, which are typically likely to fail at an earlier stage, because the founders simply do not know what they're getting into, right? And there's just so many reasons why a business could fail, but yet the investor, if they do well, is the best they can do is a linear return, right? Because law firms are not going to grow 100x in 1 or 2 years. It's going to be a steady trajectory of 50%, 75% if they're doing really well, maybe 100%. But divided between the founders and the investors, it doesn't really work out all the time, right?
Okay. Yeah, that makes sense. So let's talk about the startup founders and the goals that they have and how that needs to correlate with what they need in terms of funding. Why are their goals important? And what are the questions they should be asking themselves when they're raising money?
Yeah, it's similar to the question or the discussion we had earlier, Hesse, about making sure there's an alignment among the investors and the founders, right? Some of the questions you're going to be asking the investor is, and let's be honest, in that situation, usually it's the other way around. The investors are the ones asking you the questions.
Mm-hmm.
But to the extent that I always say you want to get a maximal return on dilution. If you've made that decision that, okay, I'm going to go to the market now and part with some of my hard-earned equity and bring in an outside investor, the question that you ask should really go to how well that investor can deliver to you more than simple dollars in the bank account. Can they deliver on the distribution side, on the marketing side? Can they bring you industry expertise? Are they a savant in the area of practice or business that you're in, where they can really help provide mentorship? Because that's also a critical component that a lot of startups look to some of the big VCs in the Valley is they've seen all kinds of burn on all kinds of deals. And it's very valuable to have a VC sitting on your board who understands the industry well, assuming that you're mature enough as a company to not be distracted too much by that level of oversight and overbearingness, if I can say that.
Yeah. Yeah.
So that's what you really want to get across or glean from a meeting with an investor is, are they aligned? Is this somebody I can work with? Because they are becoming a bit of a partner. If they're going to share a boardroom with you, they're going to be a co-shareholder with you, especially under corporate law in Canada and the US. The entire system is set up to be very pro-shareholder. So understand that when you're bringing somebody in as a shareholder, they've got a lot of rights, which means they've got a lot of power. So you've got to be very sure about who you're bringing in. And the other consideration is, are they bringing in more than just dollars? Because I'm taking on a risk bringing somebody else into the tent.
Right. And for the most part, a lot of founders may not realize that it's more than just a pocketbook. It's more than just the money that they're bringing in. And for founders, it's actually in their best interest to figure out those that align strategically, because that's exactly how they're going to scale their business, with those kind of contacts and that kind of wisdom that they're inheriting. Okay, so let's get into the different types of, let's say, funding rounds and check sizes, because this is an area that founders may not necessarily know about, and the valuation at each stage. So can you talk a little bit about that? Like from the beginning, like when you're an early stage founder and you start with, let's say, yourself funding your business, and then you go into friends and family, and then what is the path after that?
Yeah, the usual cycle is something like the founders put in their own money, of course, and then you'll see a seed round, which may or may not be an angel or somebody who's professional. It might be friends and family who are willing to take a chance on you because they love you and not necessarily because you've got all that pretty of a business just yet. And then you get into the friends and family rounds. And at some point, you are going to start seeing traction in your business. And once you do that, that's when you start looking to do the more meaningful rounds. And not to say that the earlier rounds that we've discussed aren't meaningful, but you're starting to play in the deeper waters. You're looking for venture investment. You're looking for family office investment, even retail accredited investors, and ones that are a little more sophisticated and are going to dig into your valuation and a lot of what you tell them. Whereas at the earlier stages, angels, of course, angel networks will be fairly sophisticated about asking you certain questions and all that, but they're not putting in a whole lot of money. And it's kind of, to them, it's more like we're going to give you a little bit of money to see what happens with it, but it's not really a meaningful stake for them. But once you get into the later rounds, it's, okay, well, what have you raised so far? What's your valuation, and how are you defending that valuation? And oftentimes you see founders make that mistake of, oh, I'm going to do a friends and family round for my Aunt Sally and Uncle Tom, and it's going to be a $15 million valuation, so I can go brag to the market that I'm a $15 million company. And then you get to the venture or the Series A round, and they're like, you're not worth more than $2 million. And all of a sudden you've got this down round, right? Mm-hmm. And not to say that's the end of the world, but it's a little embarrassing, and it does have an impact, right? It does have an impact on your Series B. Then they'll be like, oh, you took a huge down round from your before your Series A, right? Like, what happened there? And when you're in those investor meetings, sometimes you don't necessarily have all the time and the patience in the world from your investor, and one bad question can derail the entire meeting. So you've got to be really careful, right? All these small little optics make a difference.
Okay, so in the beginning, and this is the valuation principle that we talked about earlier, but in the beginning, this whole idea of valuing your company, it's not clear. It ends up being a negotiation between the investor as well as the founder. But once that valuation is set, that becomes the basis for future valuations. So from your perspective, in the beginning, I know there's various ways to value your company, but if a founder came to you and said, I've done this for the last 3 months and I have reached this milestone, I think I can develop my product in 3 months, what should my valuation be? How do you start to navigate that discussion before there's even a talk with an investor?
I think you canvass other industry experts and you say, look, I'm in SaaS, or I'm in e-commerce, or I'm in XYZ sector. You seek out the people that are knowledgeable in that space, that are doing deals, whether it's on the M&A exit side, whether it's the investment bankers who are raising capital based on valuations for companies in that space. And you ask them, what do you think is a good multiple that's going in the market right now for somebody like me? So you might hear somebody say, oh, if you're in dental technology, you'll get 5x. If you're in X education, you're getting 7x right now. So you can kind of understand what you need to understand, what the going market rate is for valuation. And it's going to be cyclical, right? Times like right now, or maybe last year when liquidity was a bit tighter in the market, the valuations won't be as frothy as they would be in 2007 or 2020 during COVID, when cash was just flying around, right? So those are all things that you really have to factor in. But it all starts with recon, which is being deal ready before you have to be deal ready, right? It all goes back to that same idea of not having to buy that car when you need to buy that car, right?
Yeah, yeah. Okay, so let's get into the different types of financing. And I want to start with debt before we go into equity, because debt isn't only necessarily about like getting a loan or a line of credit. It can have some significant impacts on the business, either earlier on or even later on when they're in their Series A. So what does this look like as a financing round for investors? Like, why go into debt financing?
Yeah, I think it's the allure of, I can get money from somebody else and not dilute at all. And at the end of it, I'm going to build this business spectacularly and just give them back their money, and I'm going to take all the upside. That allure in many ways can be the pipe dream that leads people down rabbit holes that they really shouldn't be going down, right? Or chasing waterfalls, right? That's really what it comes down to. Is there's a lot of, you can see from the outside the attractiveness of debt financing, but you have to recognize the downside risk, and it's typically absolute, because when your loan fails, typically the downside is catastrophic, because you've signed a personal guarantee, or your company is going to be foreclosed upon based on the assets that you put up as collateral, versus equity, which by definition, there's no obligation for you or your company to pay unless there's money in the company, right? That's probably not the best way to put it, but in many ways, if you're insolvent, it is actually illegal per the OBCA, prevailing corporate law, for you to actually pay on equity. So the investor can't even force you to pay if you don't have the money. There's actually no ability for them to enforce payment. So even if your company goes under and the worst that you did was you raised a bunch of common shares, that's the investors are, as we'd say, SOL, out of luck, right?
Right.
Whereas in debt, they've probably got a personal guarantee against you and the assets of the business, and it's catastrophic, right? All because maybe somebody thought they would get that unicorn deal on the back end. So that's not to dissuade people. You may be the outlier. Your situations might be very unique, but just know that in tech, especially, you're going outside the beaten path when you take debt financing. And most of the time, debt financing, especially if it's not in a asset heavy or an established industry, is going to come with debt servicing, because that's a risk mitigation tool for a lender. They're going to say, okay, well, I want to make sure my loan's in good standing. And one of the best ways to do that is to have you pay me every month, right? So now all of a sudden, the one thing you need at the early stages of your business are cash, and you're having to part with that cash to service the debt. And that's why there's a lot of very sophisticated investors like Mark Cuban that have very choice words for people that take loans at early stages. I mean, in Mark Cuban's words, it's the stupidest thing that an investor could do. That startup founder could do, right?
Can I ask you a weird question? And I don't know if it's not necessarily weird, but it is an anomaly, because OpenAI, as you know, is a nonprofit organization. And yet Microsoft has invested millions, of, I would say maybe in the billions at this point, to try to make their money back. And they realize it's going to take a long time for them to actually see an ROI. And like what we've seen in the news is that in the meantime, any kind of revenues that are incurred by OpenAI is given back to Microsoft as part of their original investment, because of this realization. Like, from that perspective, as a nonprofit organization, but also as a tech company, like, what are the implications of that? Because with this, how is this structure is very different, because most tech corporations, as you know, are for-profit corporations.
Yeah. Well, I think the implication for a not-for-profit in the tech space is that it's very unlikely that you're able to raise money, because you're not providing investors, despite your risk profile, with a huge upside that they can then use to raise investors. Because ultimately, a lot of these venture capitalists or a lot of these institutional investors are really just conduits to invest other people's money. So they've got to generate a return on their back end for their investors vis-a-vis their portfolio. So if you can't make your portfolio work with these outsized returns on the 1 in 20 deals that do well, the model just doesn't really work, right? In OpenAI's case, I think when you are the industry leader and the industry creator in so many ways of a really frontier industry and sector to begin with, that just has taken the world by storm, that's the 1 in a billion scenario that you can pull something like that off. And it speaks to the unique profile of the investor to begin with, right? Because Microsoft is so handsomely profitable across the board that they can afford to invest in an open AI for, in many ways, intangible reasons, right? Because what they're trying to do is, look, we don't know where AI is going, but if we can get the world's biggest superstar in AI, or one of them, we can slowly port our company over to being native in that space over time, right? All the while generating all these handsome profits that we do from our core business. So they can afford to do that. And it's not compromised by the quarterlyism that we talked about earlier, because their quarterlies are continuing to generate them excellent profits. And frankly, investors understand why you would take a position in OpenAI. So again, Microsoft is 1 in a cajillion. There's not many of those that can afford to take that kind of a swing on an OpenAI, right? And it's been synergistic. Like OpenAI, I use ChatGPT like multiple times a day. I'm a chronic abuser, right? It's worked out well, and Microsoft they're able to patriate that technology. They're able to really integrate that within their broader platform. It makes a lot of sense, even if ostensibly they're not getting a return on that asset. Across the board, it's probably enhancing all their product offerings a cajillion times.
I want to get to the other investors of OpenAI, because this leads into, this is very relevant to the question that we talked about, debt financing, because some of their other investors include the JP Morgans and some of the big banks, but instead of actually buying equity into OpenAI, they've provided convertible debt. So can you explain like from a convertible debt perspective, the outside value for banks doing this, and why it's important for founders to even think about this option for themselves?
Yeah. So look, Hessie, I can't claim to know too much about OpenAI's specific situation. I know it's a little complicated, so I won't profess to be an expert, right? But if the question is, the question is more about
convertible debt and
convertible debt. Yeah. So convertible debt, look, within the hierarchy of investment structures that a startup can take on, it's generally considered one of the most toxic from the perspective of the founder, because what you're really doing is you're giving up the entire upside with the investor not getting any of the taking any of the downside, or really sharing in any of the risk. So they're, in many ways, convertible notes or debentures have a coupon. So you're servicing the debt the way you would a conventional loan, but the conventional loan, the upside you would typically get from that is, if things go well, you just give them back their money and then you're off to the races. But here, the moment you do extremely well, they're taking the upside too, right? So it's generally considered to be and I'm not saying this is always the case, but it's generally considered to be a toxic form of financing, such that if you go into the market, and this is interesting, there's always flexes in the capital market space. The type of financing that you're pursuing says a lot about your business, or at least that's the investor perception. If you're going straight to the market offering a common share deal, for example, you're going to be perceived as being stronger and more commanding than somebody who's going to market right off the bat seeking convertible.
Interesting.
They're going to say, okay, you must be really desperate if you're looking for a CD, convertible note, right off the bat, or in general.
Well, what about later on when, let's say, you don't want to raise another equity round, and you want to reduce further dilution, so you do some short-term debt finance through a convertible, just to mitigate the chance of dilution? Yeah.
So I guess the better thing to do is, if you can, to just get a straight loan in that situation, right? It's in many ways, we talk about the valuation principle. How good of a deal can you get? The moment you're going to the market for a convertible debenture, you're getting yourself the worst deal possible, right? In that sense. So you're telling the market, like, I can't get any better deal for myself, so please, can you give me a convertible debenture, right? So in theory, a good startup in that situation would say, okay, I just want loans because I don't need any more equity. I don't want to dilute. Are you interested? And the bank would say, okay, you're mature enough and you've got enough of a cash flow proposition that we can put the money in. But the moment you go for convertible debentures, and banks don't even typically do convertible debentures, that's going to be often an investment bank, retail investors, a lot of, not always, but even a lot of vulture funds love that kind of stuff, right?
Wow.
Because it's very aggressive for them, and it's a great deal if you get in a good business that's doing well, or that has a lot of prospects, but it's distressed for poor management or something temporary. Boy, as an investor, you love that kind of deal to be convertible note, right?
Less risk. Now let's talk about the very, very early stages, and let's talk about SAFEs, because they actually don't fall into either a debt or an equity instrument. Can you talk a little bit about SAFEs and why it would be a good opportunity for some early startup founders to consider this for financing.
Yeah, safe notes are really attractive to a lot of startups because they minimize the paperwork, and by extension, the amount of money you got to pay lawyers at an early stage. So it streamlines the process and makes it a lot simpler. But B, one of the most important features of a safe is that you're actually deferring the valuation to a later date, right? So if I'm early in my company's growth, and let's say I can command at best a $1 million valuation, if I do a common share issuance, it's going to be at that $1 million valuation. So I will crystallize my round valuation, and that's it. No matter what, like I've always sold these shares at 1 million valuation, and I'm sustaining that dilution. But the beauty with a safe note is often what you're saying, or the prevailing form, what it's saying is, you give me 250,000 today, and I won't fix the valuation of those shares until my next round, typically, and you will get in at 75% of that round in terms of evaluation. And that's awesome for a startup, because if your next round is you took the investor's money, 250,000, and that got you to some kind of critical mass in terms of your product offering, and your next valuation is 10 million, you were able to really get away with a lot less dilution, because now you got those people coming in at a 25% discount to 10 million versus them just coming in at the 1 million valuation, which obviously you would have to give up a lot more of your company at that clip.
So if you're coming in as an investor, and I've heard this a couple of times about what investors' views are when it comes to safes, is this more beneficial for the founder than it is for the investor because it's not priced?
In theory, it is. Yeah, absolutely. And that's why it's so popular among startup founders, and it's all the rage nowadays. Well, not nowadays, I should say. It was more during the heyday of 2020, 2021, when startups are raising money pretty easily. I think the barrage of safe notes that we were seeing from a couple of years ago has probably slowed down as money for risky early stage investments has gone down. But absolutely, I think you could characterize safe note as very pro. I mean, in terms of the spectrum, it's very pro startup versus the convertible debenture being very pro investor.
Okay. So let's say near the end of a founder's journey, they've raised a bunch of capital through these different rounds. At what point would you say, and maybe this I should say this a different way, from a dilution perspective, what should you make sure as a founder in terms of how much equity should you retain after, let's say, a Series B, to make sure that at the end of the day, when a liquidity event happens, that you're not left high and dry with nothing? How do you manage that along the way?
Well, look, there's a lot of good financial planning that goes into it, and that's part of having a good financial advisor and accountant to really help you map out your long-term cash flow projections and your runway. That's very important to understand that at your current burn rate, how many months can you survive? You want that runway to be 18, 24 months. From a capital raising perspective, it always looks healthy. But I think there's also something important that a lot of founders should understand, that before they even get into the analysis of whether they want to raise money. And it was captured by a good friend of mine who is very big in the startup private equity tech space. And he told me, look, the best startups don't need any money because they are cash flow positive at an earlier stage. They don't need to bring in outside people's money. So when we talk about the flexes and the signals to the market, in theory, the moment you go to the market, there's some reason that you're going to the market that that requires you to be there, because you can't sustain yourself based on cash flow. That's not always a negative thing. Obviously, Shopify went to market, and no one's going to take fault in their business proposition, but that's just the general spectrum of things, right? So, but I think it's important for founders to realize the goal shouldn't be to get to a point where you can raise outside money. That should be seen as a necessity to get you to the next stage. But the ideal is always if you can bootstrap it and then finance it through cash flow. Now, again, that's not always, cash flow might not give you the exit velocity that you need to really get things to the next stage. Or if you are in something like AI, like a new industry where you want to really achieve a certain scale very quickly, waiting for cash flow to buoy your trajectory is not going to be maybe the best strategy. So you've obviously got to make extenuating considerations like that. But in general, it's just important to understand that it's not part of the ideal business cycle to raise outside money. The ideal business cycle is you get to being profitable without having to bring in any outside money.
Right. I think the idea though is that if you're going to do it in a short amount of time, and if you can scale it faster, the only way to do that is really with outside money. And if you end up,
you're right. To be fair, I mean, there are certain industries like pharma where the entire industry is based upon years of R&D and things that burn a lot of cash before you'll ever get to the point where you can generate sales. So everything I'm saying, like it's got to be tempered by the specific industry that you're in, right? There's no sort of one size fits all. But the reason I kind of gave that proposition or that principle is just to help investors understand that you want to raise money very guardedly and very cautiously, right? It's not some happy event that you raise money. That just means that you brought somebody else in, right?
Yeah.
And it goes to the valuation principle, like put it off as much as you can, right?
Yeah. That's very interesting that you say that. I think it's because a lot of the articles that I'm reading are saying that there's a positive signal to the market when you actually do raise, because it creates a confidence in the kind of company that you're building as well. But you're absolutely right. At some point in time, you have to understand or balance out the risks to you as an individual and to your business. One thing somebody said to me though, I may be diluted.
Can I just jump in very quickly to your point? The reason why you raise money is actually important too, right? A lot of situations that you referred to there where it's a strong signal to the market, not all of them, there is a certain market validation. And a lot of times companies go public, we see, because they want the notoriety of being a public company, their profile changes and whatnot, right? But it also depends on why you raise the money, right? Some companies, like you think of Facebook, for example. If I recall, Facebook actually went public, not necessarily because they needed the money, but because I think not because they needed the public money, but because I think they actually had a regulatory reason where the regulators were essentially saying that, look, we're going to treat you as a public company because you have so many investors or you've grown to a certain size. So they said, okay, so we might as well now go do a gargantuan IPO. Now that we're forced to become a public company, let's just go all out. And if you remember that IPO, it didn't do so well initially because they were able to overprice it so much, right? Because they were so oversubscribed, right? So those signals that you're talking about, the reason why Facebook was able to do so well is because they were able to send all the right signals that we don't need your money. We just want it because we're being forced to go public. So, right. And so all those things do resonate, definitely.
Okay. That's awesome. I'm learning so much. You have no idea. I think I have one more question for you because I think we're running out of time. But if there was a way you could sum up what it looks like from what does success look like for a company that's done this right, that's structured their company in the right way, that's actually asked themselves the right questions and brought on the right investors, what would they look like when, let's say, they get acquired or when they IPO?
Yeah, I mean, success, I wish I had the answer to that question. Success is like beauty in the eye of the beholder, right? So if you're I suppose you could say success, the best way to measure it is the extent to which you achieve your goals, right? If your goal was to exit and you were able to pull that off within the range of what you were looking for, that's success, right? For some people, that's not good enough because they got to a certain point and they thought they could have done better, but then the deal they got wasn't that good. So it could go on forever. In some cases, it's not fair because in that latter scenario, you look back and you go, look, in absolute terms, you were a success. Even if you were not content, it was successful, right? But that person might not feel that they were successful. So it means different things to different people. But ultimately, the way the outside world's going to look at you is how well did you accomplish what you set out to do?
Mm-hmm.
Right? It's like any one of these great conquerors that we study in history, whether it's Alexander or Cyrus, or when they said, I'm going to take over the world, you judge them based on how well they accomplished those goals, right?
Yeah, exactly.
And so many people that were not Alexander and Cyrus that didn't get there, right? So
yeah. And I think you're right. A lot of it's personal. And then the founder at the end of the day will start to ask himself, what do I want written on my headstone when I die? Like, what difference did I make in the world? And maybe you're right. It is a personal thing. It may not necessarily be as tangible as we make it out to be. So I think
it would be different to investors than it would be to founders, right? Investors make a lot of money, but founders didn't get the same handshake, or vice versa, right?
So yeah, absolutely. There is a balance, but sometimes they say, even if I'm diluted to 5%, 5% of 100 million is not so bad at the end of the day. So.
Exactly.
But anyway, I want to thank you so much for joining me. This was, I think, one of the highlights of some of the podcasts I've done this year, and just learning more about this topic. And you've given me a lot to think about, and you've disrupted some of the thinking that I've already had about raising money. So thank you so much.
No, thanks for having me, Essie. And I think it comes down to, all those principles are great to know what they are. Like, it's always good to know what the rules are. And this is maybe something I attribute to my legal background, is the rules I always look at as landmines in the field, and you're trying to get the client or the business to the other side of the landmine, to the greener pastures, or the field, the gold mine on the back end, right? So the rules are there to help guide your way and to tell you what not to do, right? But that doesn't mean that you don't traverse the field for risk of hitting up against the rules and the do nots, you know? Yeah. So all those things that you're saying are important to know, but you also need to really understand beyond them and understand why the rule is what the rule is, so that you can navigate it. The why is the critical thing, not so much the what.
Thank you so much, Mujir.
Thank you. Thanks for having me.
I appreciate it. So for our audience, this is indicative of the type of topics that we cover in our investor readiness program. And, people like Mujir really help our founders really understand topics like this. So if you are interested in going to attending one of our sessions on investor readiness, please go to our program page at altitudeaccelerator.ca. If you do have topics that you want us to explore on Tech Uncensored, please email us at communications@altitudeaccelerator.ca. Tech Uncensored is powered and produced by Altitude Accelerator. We're hosted on Spotify, and you can find us wherever you get your podcasts. In the meantime, everyone, have fun and stay safe.